All right. Well, Mr. Jim, thanks so much for joining us today. It's always good to have someone who has walked the path, right? Someone who's not in that spot of, oh, okay, I've discovered this might be a good idea for you, for me, right? But you're past that point. You're even past the point of I'm going to start taking action, and you're past the point of, man, this is a really great, asset class basically to focus on to meet a lot of my goals. I think that's really encouraging for people to hear, someone who has walked the journey and not even in a long period of time. It's, people hear Eddie, it's nothing against Eddie, but when you've been doing it for 40 years, it's like, of course you're successful, but to hear someone go from, I'm a normal investor. I've just simply switched from, this rental business over to this note business. It's not like you run a $1 billion hedge fund or something. You're just an average guy, right? So
That's true.
It's always good. It's always good. Well, we had people from all over the country kind of chiming in, and one of the things that I wanted to ask about really your story is: was there a moment for you when it talks about, when you were looking at obviously the financial side of it, was there a moment where risk was a variable, where you said, hey, I think I can start to reduce a lot of my risk? Was that important to you from a long-term perspective?
So yeah, risk, there's, when we talk about risk, and I'm also an analytics guy, right? So one way of understanding what is risk when we look at it on a spreadsheet or we look at it on a graph is volatility. That is a kind of like an index of risk. When you see that graph going a lot like this, that's volatility. That's also risk. So one of the things that happens with, say, for example, rental investments is from year to year, you have that volatility. It's like you had to replace that aircon. You had to do this, you had to put the new roof on and so forth and so on. This thing happened. And so your vacancy rate was up and so forth. So when you talk about reducing risk, one of the ways that you can understand that you've reduced risk is if you reduce the volatility in your returns into a range. And that's what notes do, isn't it?
Yeah, absolutely. Ed, do you want to say something?
Yeah, Jim, it's refreshing because you are essentially repeating back what you've heard me say, and that is people get drunk on yield. And you made reference to the spreadsheet earlier, talking about rehabs and rentals. And you've got this beautiful spreadsheet. And my guess is, knowing you've got this very beautiful spreadsheet you started out with that ran all these models. And then all of a sudden, oh my God, this wasn't in the model, right? In other words, the spreadsheet says this, but your checking account says something else. And that's the thing that I think the reality with notes is, people are like, oh, my rentals are great and they're going to do this for me or that for me. But the truth of the matter is, rentals are highly management intensive, correct? And in mismanagement or just missing expense that's naturally going to happen makes that volatility of your yield exactly what becomes the problem.
Yeah. Yeah, absolutely. And I think when we're talking about volatility, for those of you who maybe that's not a super common word in your vocabulary, I think a really common indicator for even the newest of person is the market's going like this, right? If you have assets right now that you don't sell and the market drops 20%, your net worth just dropped 20%. That is a picture of volatility. And if you've been following us a long time, you've heard Eddie use this scenario all the time about, by being able to take what's available to you now. We've talked about seller financing on this TV show as well, where if you sell it now with seller financing and become the note holder, if the asset drops 20%, that volatility falls onto whoever bought the house, not your net worth, not your cash flow. And so it really becomes this conversation of really protecting what you've gained. And listen, if you've been investing in basically anything in the last 10 years, you're probably really proud of yourself. You've done very well. It was very difficult to lose a lot in the last 10 years, but things don't go like this forever, right? And I think we all know that. And so how do we start to mitigate our risk? How do we start to address some of these volatility issues? and really lower our risk, but keep our returns. This is something I think landlords really cringe at, because they're like, but if I leave the landlord space, I'm making all these returns, because they're just looking at the paper. They're not looking at the fact that all this money went into a property that had the same cash flow driving down the return on investment. They're not looking at the market rolling over. And so this is all just really good stuff to kind of soak in and kind of look at from the standpoint of, this might be something to really consider, because the market conditions are really primed for notes to be a big conversation. And obviously, as you've seen in the last year, NoteSchool growing and the success of these students, I think it just does a lot for us to hear this. And so it's really, really good. Eddie, you got anything else before we wrap up?
You know, Jim, they say the longer you're in the business, the more likely you are to attract to notes. You've been in. You started this in 2001, correct?
2007.
2007.
Mm-hmm.
Okay, well, that's about 14 years now.
Mm-hmm.
14 years, and you're a little more gray-haired than you were 14 years ago. And it's funny, as the grayer our hair gets, Brian, the more likely we are to attract the notes. And I started in as a young guy, 20 years old, and Brian, you started as a young guy.
Yeah.
And I think, Jim, you would say that if you make that transition quicker, you're going to like yourself better.
Well, yeah, I mean, it's funny, we have this funny human side that causes us to do things that the intelligent side of us would tell us not to do. And I confess, I still do. I still invest money on things that look like they would be fun. That the intelligent side of me says, Jim, why are you doing that? You already know it may be fun. A lot of things might be fun. Skydiving is fun to some people.
Yeah. Well, and I think, to speak to those who are watching this right now, who maybe you relate more to my age bracket, right? And I will say this, that the best advice you could possibly get is to listen to advice from somebody who's been there. And so it doesn't matter what your age is. You could be 20 years old. I mean, when Eddie Speed starts this thing at 20 years old, it's telling you that age isn't a factor. It's literally about taking in the information, being open-minded to say, maybe these guys know something, and then see where this fits in your business. The beautiful part about notes, in my opinion, is how flexible and malleable it can be. It can really fit into so many different aspects of your business. And once you get a taste, as you see, you kind of just say, hey, this might be a thing I want to really focus on. Yeah.